Welcome to The Riff, where writer and investor Bern Hobart and I discuss the major inflection points caused by technological change. Our weekly conversation covers the obvious and not so obvious ways in which markets and businesses will adapt as a result. Let's jump right in.
So Bern, let's start with this week about this idea of how the economics of conferences mimic the economics of cities. And you went to, of course, the Manifest conference recently, Manifold conference recently. Why don't we talk about that?
Yeah, sure. So I've been interested in the economics of cities for a while, and what I think is particularly underrated is this feedback loop where if there are different jobs you can do, and some of those jobs benefit from being around other people who are either doing the same thing or doing adjacent useful things. Founders want to be in part where the money is and also where the talent is. And so they go to the same place. And that means if you have either talent or money you want to invest in early stage companies, you go to that place too. And then there's this side effect where as that happens, wages in that city go up. Property markets are like real estate is pretty inelastic in the short term. And even if it is elastic over a longer period, sometimes some of these cities limit construction. And so you end up with just the cost of existing in that city rising over time. And that tends to price various people out. But the people who are least likely to get priced out are the ones who move to a specific place that is very complementary to their skills. So you actually end up with this feedback loop where cities get more and more specialized. And you can think of a conference as basically imposing that for a narrower specialization and over a shorter period of time. But they basically they pick some place and they make it, one, the place where all the people interested in X are going to be, and two, a place where it's just very expensive to be, like you're paying to be at the conference. And so there's a higher opportunity cost for your time, and you're generally there for a finite amount of time. And so you end up with exactly the same dynamics where you have these spillover effects where everyone has useful things to say to one another. They have useful ways that they could work together. And what's really interesting is that living a more internet-mediated life actually increases the value of these conferences because, one, there are a lot of people online who you can actually meet for the first time in person at the conference, and two, the people you meet at the conference who you didn't know before, you can still keep up with them online. So it raises the value of these short-term in-person gatherings, and I think that's it's a really neat economic dynamic, and it's been going on for a long time. I think when I first started reading the Forbes 400 list in the early 2000s, I always liked Sheldon Adelson's piece because it talks about how he was renting money for X amount per square foot in Vegas and then renting it back as Comdex for orders of magnitude more. And that's a pretty cool thing to do. That you temporarily make the absolute center of the consumer electronics business this one little convention center in Vegas, and then, or not little, but one convention center in Vegas, and then you charge this markup based on the price of real estate in the place where all of the people that someone in that business would want to talk to happen to be. So it's a neat little model, and I think that there should be more of those. I think what it also tells you is that just because that you can continue to keep up with people afterwards, and that there is just going to be this huge concentration of interesting people to meet and people you can get introduced to through other people, that it is actually optimal to just bounce around in conversations a lot more than you naturally would, because you can always follow up later, and just maximizing your surface area probably means you have more future follow-ups. Whereas if you do the very polite thing and have extended conversations with a small set of people, like that is a lot more satisfying socially, and is also just a nicer, more polite way to behave. But it does mean that you have a really high opportunity cost, and if you're spending finite money and finite time to be in one place, and you are trying to ruthlessly optimize it, that is one way to do it.
It is interesting. There's another city project going around called Edge Esmeralda. Our friend Devin Zugel started it with the team that did Vitalik's pop-up city called Zuzulu. And this pop-up city model is like a hybrid between a conference and like a temporary city. And they're actually, Devin wants to start a proper city, and this is like a way to MVP it or bootstrap it. So it's also an interesting model.
Yeah. Like if you look at, I think the history of some of the medieval cities that turned into trade cities was that they started out that there was a fair once a year where everyone knew that if you show up there, you can buy and sell stuff, and you can settle debts. And so you would tend to, like, if you were borrowing money for a year, you would plan to settle it at the next at the next trade fair. And sometimes just the trade fairs got longer and they got more frequent. And eventually it was just, Frankfurt is just a city where people buy and sell things. And if you go there, you will probably find counterparties for whatever it is that you want to trade. So there are some precedents for that, although that was a long time ago. And I don't know that there are more recent examples where a city went from being intermittently the center of some business to being always the center of that business, or to having more of a presence in that business. I guess maybe the fact that there've been finance industry conferences in Florida for a long time. People really like a good reason to go somewhere warm if they're working somewhere cold and it's winter. So that's been going on for a long time. And then you did have companies move from higher tax cities to Florida, citing tax rates frequently. So there's maybe a precedent there, but I think it is a weaker one, and it's unclear to me how durable that move really is.
So there was also a sort of kind of a hit piece that came out of the conference. It's kind of like funny how sort of accusatory it was, and sort of name calling or hall monitory. Any reactions or thoughts from that?
Yeah, I think sometimes it's just kind of inevitable that if there's a group of people that some subset of the media have given themselves permission to really despise, and they get together in some organized way and do something, that it's an inevitable byproduct, just, in the same way that if you eat a large meal, there will be just this inevitable byproduct many hours or, the next day or something. And, you just kind of want to deal with that and shunt it to the side. The Guardian approach is more like a newly potty trained child who really wants everyone to look at this output of this inevitable output that they have created. So yeah, but what I also found kind of sad about the article was, I don't know, there were a lot of really interesting discussions, and it was definitely not a monoculture. Like, monoculture, it can be nice to hang out with people who all 100% agree with you, but it's just a lot more fruitful to hang out with people with whom you have productive disagreements. So there was like a really wide range of acceptable opinion within the conference, and a lot of people arguing over even some of the points that the Guardian hit piece mentions. And I think people were trying to understand the other side. And I also, I don't know, there were, so the Guardian does make a big deal about things like people giving talks on embryo selection, and sometimes just kind of biting the bullet on terms you might use for that. And I think it's like, it is reasonable to be concerned about those technologies and their deployment, and to ask what the long-term impact is. And it's not something I would personally do, but I also suspect that it's just going to be pretty widely adopted. Like either it doesn't work, in which case you're writing a hit piece on rich people spending money on a treatment that doesn't work, and that doesn't actually seem like a huge social issue. Rich people waste lots of money in lots of ways, and it's just not a hugely pressing concern. And then if it does actually work as advertised, which seems more likely than not at this point, although I'm definitely not an expert. You want to know. You want to know if there is some set of treatments that are going to be available early on to the rich and not to everyone else, and that will give the children of the rich a leg up in various ways. Like that kind of thing matters. And what you really, really don't want, if you are ideologically opposed to that, you really don't want there to be a monopoly on discussing that topic and its implications, and that monopoly to be held by people who have totally different views from you. Like, you don't want the important conversation about an issue you care about always happening in a place you're not invited to, or a place you've disinvited yourself from very noisily. It just seems like an incautious thing to do. And so I do tend to be a believer in, if someone has really, really noxious ideas, you want them to be able to share those ideas in a way that gives other people a chance to knock them down. And you can worry that sometimes these ideas will catch on, but that's just, I think it's a healthier equilibrium to be just, kind of have some situational awareness about what ideological strands are getting more and less popular, and who's advocating what. Like it seems healthier to know about that than to just have this reflexive habit of Googling the most controversial people who were in attendance at a conference, and then rehashing other things that people have said about how bad these people are. That just it seems low value added compared to the value that can be added in other ways.
Yeah,
but I guess there's demand for it.
Yeah, but it feels like the demand is dwindling. I don't know how much longer we will continue to have these sort of hectoring pieces. But But I want to segue to something else you wrote about, which was about meme stocks. Talk about the trolls of Wall Street and why the rise of meme stocks was more complex than we thought.
Yeah, so I had I'd looked at Wall Street Bets, I think in early 2020, and actually wrote a little bit about it. And I thought it was interesting that retail investors were coming back. There was this long period where there were still professional investors in the market, but it seemed like the average retail investor was increasingly deciding that index funds are the way to go, and that picking individual stocks is really hard. And all of this is actually true. Like, it is probably just better for the average person to choose to just buy a diversified set of assets and then kind of sit on them and not think too much about it. But it is also really fun to try to actually pick winners and short losers and things. So I definitely recognize and appreciate the itch to do that. But when I started following the GameStop thing, it by the time I was paying close attention to it, there was sort of this narrative in place, which is that a lot of people on Wall Street Bets are buying GameStop, and specifically buying GameStop calls, and that kind of the ringleader of all of this is a guy named Roaring Kitty, or his handle is Roaring Kitty. And it does turn out from that book, from the book The Trolls of Wall Street, that there were earlier precedents that Roaring Kitty was definitely involved, but he kind of got more attention for just being unusually willing to gamble large amounts of money rather than for his analysis. And there were actually other people doing pretty interesting analysis, including people looking at the numbers, the order numbers on receipts, and trying to use that to impute GameStop sales, because GameStop still use sequential order numbers on receipts. And that is something that professional investors actually do. Like, if you are looking at a company in great detail, you look for cases where they are accidentally sharing some data that is useful data for modeling the business, but that not everybody else has. So it was interesting to see just how sophisticated some of the analysis was. And then no matter how sophisticated your analysis is, if you make a trade, if you have a trading idea and you're right, and someone else makes exactly the same trade without having done the same research, or they did similar amounts of research, but got some parts of the thesis wrong, it doesn't really matter. If they took more risk than you did and you were right, they will make more money than you did. And that is part of the story of GameStop. But I also think you can sort of step back and say that really the story of meme stocks, it is this intersection of a couple different forces, one of which is that a lot of the meminess was actually kind of derived from, or they get borrowed from 4chan culture. And 4chan is a very interesting source of just, new, very weird things online, in part because it's an entirely anonymous message board, and there's a strong cultural norm against identifying yourself if you post there. And this is like a weirdly two-sided norm of, like, it is within 4chan, it's strongly discouraged to tell people who you are, other than, like, I'm an EMT, here are my stories, or I work at a fancy restaurant, here's some crazy stuff that's happened. Like, that's fine with them, but actually identifying yourself by name is generally low status. And then in the real world, saying that you're an avid 4chan user, also very low status. So it is its own separate thing. And not only are the posts anonymous, but they also get automatically deleted in a pretty short time period. And what that means is that for a meme to thrive on 4chan, it has to be something that people repeat a lot. And that means that 4chan just really, really selects for virality in all of its forms. And this is why things like the original just memes as a term for here's a funny image with a funny caption, that is very much a 4chan thing. And 4chan just got very good at creating those and evolving those, and then they broke containment. So you have this site that just selects for the maximally viral way to state any idea and the maximally oppositional adversarial way to state it. And then you have Reddit, where reddit.com is just general interest internet stuff. And then there are subreddits that are very topic specific. And the Reddit homepage is going to rank content partly based on your behavior if you're a logged in user, but also just based on general popularity on the site. And within investing content, there are plenty of questions you can ask that are not going to be super controversial, or the argument about them is just going to be an argument that a lot of people are not that invested in. But also, you can just post fun stuff about gambling, and that tends to be pretty viral. And if you think of Reddit, and this is probably less true now, but originally part of the way to succeed on Reddit was just post something where people can very quickly absorb what you posted and hit the upvote button. It's more competitive than if you post something and it's a long article, people have to spend 30 minutes reading it, and then they go back and maybe upvote it. And by that point, it is well down the page of new articles and is not going to make the front page. So they're like the existence of Reddit selected for punchier, weirder, more extreme discussions of finance and stuff like, if you were just browsing Reddit and for the first time you saw someone post loss porn, which is, you had your Robinhood account, you ran it up to mid six figures, and then you lost literally all of your money in a day from Tesla options or something like that. Stuff is just extremely weird and striking, and people will absolutely upvote it. So I think that meant that those, as the 4chan-ish attitude trickled into Wall Street Bets, it made Wall Street Bets more viral within Reddit. And then you had this weird hybrid thing. And then the other thing that all this collided with was just for a long period after 2008, a lot of investors just did not want to pick stocks and did not want to take very much risk. They felt like a lot of this stuff is very, very complicated, confusing, and possibly some kind of scam, possibly a huge scam. And it's this very low trust environment where, at one level, like, most of the time, if you say there haven't been no heads of investment banks have gone to jail recently, that is like a testament to the fact that we can trust the financial system. Like, our financial system is not run by criminals. And then post 2008, people were saying no heads of investment banks went to jail, in the sense of they really should have. Like, they clearly messed up. Surely there was some kind of criminal behavior here. And I think over time that just got, that meme was not selected for as strongly. And the people who had been in high school in 2008, so didn't have this huge direct visible effect on them, they're now old enough and making enough money that they do actually have meaningful savings and can start investing. And so that post-crisis generation that just doesn't really remember the crisis or doesn't remember it as being all that bad, they started buying stocks. And there just turned out to be a lot of them. They're internet native. They are more likely to know how to make things go viral. They're more likely to be part of that virality increasing process. So I think that is also just a big piece of what happened with meme stock. So it becomes less of a story of any one person. Like, I think someone like Roaring Kitty and the other GameStop fans did make it more likely that it was GameStop that was the stock that that meme stocks really, really took off with. But something like this could have happened with other stocks. It could have happened at a slightly different time. It was kind of a historical inevitability given the ranking algorithms and then this demographic effect.
We'll get back to the conversation in a moment after a word from our sponsors. Fast forward to the end of 2024. Think about your goals. What can you do right now to give yourself the best chance of succeeding? If learning a new language is on your list, you absolutely need to check out Babbel. Babbel offers a range of learning tools, self-study app lessons, live classes, and even podcasts, which have always been my favorite way to learn. Studies from Yale, Michigan State University, and others continue to prove Babbel is better. One study found that using Babbel for 15 hours is equivalent to a full semester at college. Babbel isn't just a game to kill time and make you feel like you're learning a language. It's not overly academic or rigid either. It's all about learning language for the real world. Babbel stands out because it's designed by real people using a modern conversational teaching approach. It's not always easy, nothing worth doing ever is, but it's straightforward and designed to help you start speaking in just 3 weeks. With Babbel, I was able to brush up on my intermediate Spanish to ramp up for travel to Argentina last year, and was able to set clear goals based on how much time each week I wanted to practice. Join millions of Babbel language learners across all age groups. Here's a special limited time offer for our listeners. Right now, get up to 60% off your Babbel subscription, but only at babbel.com/Torenberg. That's babbel.com/Torenberg, spelled BABBEL.com/Torenberg. Rules and restrictions may apply. If you don't already subscribe to Turpentine's industry-leading newsletters like our new daily AI newsletter, Emergent Behavior, or Media Empires, you should. But that's not what I'm here to tell you about. The platform we use to power these newsletters is called Beehiiv, and it's excellent. First of all, it was started by the same early team who helped build Morning Brew into a $75 million newsletter business, and they built Beehiiv to offer that same powerful functionality to anyone sending emails. From essayists to business owners, the platform is beautiful, their text editor is intuitive, and they help you scale your audience with custom growth features. Beehiiv has powerful tools to help you monetize your content. You can easily launch paid subscriptions or pursue an advertising model. The Beehiiv platform will even connect you to premium brands to sponsor your newsletter. Not only do we use them, but thousands of the top newsletters in the world also use them, like Milk Road, Blockworks, the Lindy newsletter, and so many more. Beehiiv's founder hooked up Moment of Zen listeners with a sweet deal. Get 20% off for 3 months with code MOZ. Visit beehiiv.com, that's BEEHIIV.com, to get started.
Do you think this is likely to continue to keep happening, variations of this? Or do you think this is kind of a moment in time?
Well, I think that is like the reputational equivalent of would you sell GameStop calls, and I'm sure plenty of people have made plenty of money just selling naked calls on GameStop of like the volatility is too high, it's got to go down, the stock price is too high, it's got to go down, and then a lot of people have lost a ton of money doing that. So I want to be very cautious here and say that I think that a lot of the setup in early 2021 was pretty conducive to that. That you did have more portfolio managers who were doing fairly concentrated compared to today short positions in small companies, just knowing that this company it's a dying company in a dying business, it's going to go under in not too long, and so it's pretty safe to short it even if the short interest is high, because who's going to get really excited about GameStop and pump up the stock? And then it turned out people did get really excited about GameStop, and the market cap went from $250 million to tens of billions in a couple months, and now that experience is part of everyone's explicit risk model if they have one, and their implicit risk model if they don't, of just sometimes stocks go pretty crazy, and so if you are short a little garbage company, you want to try to cover very early if it starts moving up. And in fact, a lot of hedge funds did cover their GameStop in particular and other meme stocks during that run up. So towards the end, it was mostly meme stock investors trading with themselves and generating a lot of money for market makers and for Robinhood. But yeah, the short interest really did provide a lot of potential energy, and also just if you're going to make if you have some popular piece of intellectual property and you make a sequel, you have to do something that improves it. Like, it gets better distribution because people know what they're looking for, but also the reviews will tend to be worse. And if it's a collaborative effort and you actually don't have any control over who's collaborating with you on doing the next GameStop run up, then it's very hard to ensure that quality. So I don't think something quite like that would happen, but retail investors still have a lot of financial firepower. Wall Street Bets is still big, and people know that this is a way that they can potentially increase their returns as individual investors. Is buy something, invest in something smallish, try to create a little online cult about it, and see how far it can go. Wall Street Bets has, to their credit, they do have rules and norms against posting stuff about small cap companies. I think it's possible that there was this sort of metagame where people on Wall Street Bets who were following GameStop discussions elsewhere might have gotten this sense that the Wall Street Bets mods are less likely to remove GameStop content once its market cap is over $1 billion. So that is actually the time to buy, that it's actually more hypeable when it's already gone up than it was before.
Yeah, it's interesting to imagine sort of a rigorous study of 4chan's cultural influence. Right? We're talking about finance, but also politics. And in general, it's interesting if we had like tracking as to where memes come from. People often say that Twitter is a big source of culture, certainly of news, because the people that make news and make politics are obsessed with Twitter. But it feels like, especially before Elon took over, 4chan or Reddit was like a big source for Twitter. Like an idea would be tested in 4chan or Reddit and then sent over to Twitter. So one, it's just interesting to think about where culture comes from. Separately, it's also interesting to think about not just the provenance of these ideas, but also if you had a market to speculate on them. And some people have tried to do this, create meme markets of sorts. Like if you discover a meme or account that you think is going to get very big, is there a way to financially, bet on that such that you get upside from it in a way that you do when you discover a stock? And so that's also interesting to think about if that will exist in some form.
So I wrote about something adjacent to this, which is I was thinking about companies and their capital structure, and you could think of the extended capital structure, like the economic, there's the financial capital structure of they issue stock, bonds, maybe some warrants, maybe some preferred something or other. And then there's this sort of extended way to think about that, which is different people who interact with this company have different sources of upside from this company, and that you are, in some vague sense, you have some like vague form of reputational equity if you're talking about a company and you say this is a great idea. Like, either I'm not investing in it right now because I don't have the money or don't have the access to the round or whatever, but like I think it's a cool company. Like, being able to go back and say I thought it was cool back in the day does give you some kind of credibility, so you sort of have equity. And then I think there's a set of companies where implicitly their customers have a form of equity in the business, because if they choose the right product, either they choose the right technological standard to adopt and then other people choose it, and so it becomes something where there's more open source software around it and there are more people who know how to use it, but your company knows it better than other people. So this is like TSM adopting EUV, or like companies adopting particular open source frameworks or particular programming languages. Like, they are sort of getting equity in it. And also you can think of people like early fans of Taylor Swift get some street cred with their friends from being able to say, when no one had heard of this person, I was really into their music. And I think that that eventually becomes negative equity, because eventually, like, the people who were really impressed that you were a couple years early then decide that this person is now cool enough that it's actually uncool to think they're cool, and so it flips the other way around. So the financial structure of a pop culture fan is complicated, but I think that is probably the closest you get to being able to monetize the ability to spot memes, other than just doing it literally. Like, if you're the first person to put Pepe the Frog on a shirt and not get a cease and desist, then you probably make some money on that. I don't know. But other than that, it's hard to convert that into personal financial benefit. And it is especially hard if it arises on a forum or a community where there's a strong norm against individuals taking credit, where it is seen as a collective enterprise. At that point, that is like your last interaction with the community, is taking credit for what the people in that group consider a group effort. In terms of tracing ideas across different sites, like which sites are more generative of ideas, which are less, my guess is that you would see much less breaking news on Twitter. Just, it's way too easy to fake it, so news doesn't usually break on Twitter. But narratives definitely can form on Twitter, because narratives are partly, it's partly about whatever actually happened, but it's also partly about what is the socially acceptable way within my peer group to think about and talk about this event. And so if you are early to have the take that all of your immediate peers decide is the correct take, then you do end up defining that narrative within your peer group. And if you and your peers all happen to be journalists, then that ends up defining the narrative that gets put into the mass media. Reddit, a fair number of good ideas percolate up on Reddit, but it seems like Reddit is actually a really good place for sort of high hit rate but low expected value ideas. This is pretty much what people are looking for when they search for best and then product name and then Reddit, is they're just trying to find, what does, like, a person who cares about this enough to have written about their preference for it, what do they think is the best? And then you tend to get a pretty good idea, but you're very unlikely to find something just completely mind-blowingly amazing from that approach. And I think it used to be the case that the comment sections on blogs were actually pretty generative, and that a lot of ideas would start out as just a point someone made in the comments somewhere and then just catch on. And I think just the fact that those are less viral means that the people who are trying to do that have migrated more to Twitter instead.
Yeah. Segueing a little bit, you wrote a blog post about this idea of who captures value, founders, investors, employees, et cetera. Why don't you talk about what you were trying to unpack in that post?
Yeah. So that was the main piece that also talked about the ASML and Taylor Swift economics connection. But yeah, the main thrust of it was just thinking about when someone starts a company, the founders initially own all of it just by default, and then over time they potentially just keep it, or it gets slowly distributed to employees, or they actually raise outside money. And one way to think about that is that if you have a capital intensive business, then making it happen means you are paying for capital. It means some of your returns go to the people who provided the money, even if they weren't actually working on whatever it was that you were building. Which is just something that you kind of have to accept if you're starting some business that you can't fully afford to fund. But also there's this interesting signaling dynamic where if you refuse to raise outside money, part of what you're saying is that you're optimizing for owning the largest possible stake in the outcome. And if you are a profit maximizer, that should be an input into your calculation, but it's the main input only if you think that the size of the opportunity is pretty capped and that you can actually fully exploit that opportunity in time. And therefore that the big difference in your outcome is whether in the end you own half of it or own 99% of it. And by that standard, if you raise outside money, part of what you're saying implicitly is this idea is going to be so profitable that I would much, much rather have a better chance of executing on it and end up owning 5 or 10% of it than to be sure that I own all of the upside, but also be not entirely sure that I actually end up getting that upside in the first place. So I think that kind of signaling thing is it's just a useful way to think about the scope of opportunities, and it actually has a nice symmetry with the idea of a business being venture scale or venture backable or not, where there's a whole category of businesses that are economically viable, they're useful, but they just don't have any possibility of returning the fund if you put 5% of your LP's money into this one idea. So that there's, if it's a barbershop or a local chain restaurant or something, it's just very, very unlikely to go up 20x in the life of a standard venture fund and make all that money. So you actually end up like that signal actually ends up being a useful signal from the investor's perspective too, where they are not asking how do we make sure this idea actually happens. They're asking how do we maximize profits from that. But that also means trying to find a fit where the founder is not just trying to maximize their stake, they're trying to maximize the expected value of that stake and also trying to get the business built. And that when maximizing the expected value of the stake means raising outside money, that does imply that it is a sufficiently scalable business to be worthy of raising that outside money.
Yeah. And it is interesting because I've been thinking about I raised a bunch of money for previous businesses, and there's been kind of this trend among people who've raised a lot of money to appreciate to not raise money for the next venture if they don't need to, if they can self-fund it. Because when you raise money, you have a boss, you're not always aligned with your investors, right? They're always wanting, or these venture capitalists are wanting sort of this go big or go home. There's a high liquidation preference. It takes a lot of options off the table. It maybe increases the chance of outlier success, but maybe, takes some options off the table for immediate level success. And immediate level success could be life-changing for, could be $50 million, could be $100 million for someone. And that said, if one is to do that, it's worth fully, understanding what trade-offs they're making. And I think you outline a few of, when you raise a lot of capital, it signals to the market that you're serious, that you've been validated. People like working on things that are super well funded. It's high status.
Yeah. If you are able to self-fund your idea, I guess from an asset allocation perspective, it's probably the wrong thing to do. But that is not the only way to think about your life. And one way to think about it is you can give yourself your dream job and you can hire the team you want to hire, and that, potentially you personally have enough money to fund this idea to get to the point where it's self-sustaining and you expect that you don't have a lot of risk of someone else trying to run away with the market. So that is one option. And one way to look at it is also that you self-fund for long enough. If you have an idea that you think median investor is not going to get, even the best investors won't necessarily understand quite what you're getting at, then maybe you actually have created this underpriced investment where you are the smart money and you should just buy all of it at that price. And then at some point, either you don't have quite enough cash to fund it, or just you feel like it's imprudent to go from I never have to work again to I actually have to work insanely hard all the time, or I will lose all of my money. And I will have not only wasted all of the work that I'm doing on this, but I will have actually retroactively wasted all the work I did on my previous startup, which I thought made me a life-changing sum of money. But here I am with exactly the same life I had before. So there. But if you do validate the idea enough on your own, you probably end up raising on better terms if you're right. And if you're wrong, you did a nice public service to investors by not pitching them on an idea that they probably would have funded and they would have lost their money on. And you also had this journey of self-discovery where you figured out, where on the lucky versus good continuum you are versus where you thought you were. And it is healthy to know that, especially like if you're at a point in your life where you can start the next company, then that kind of self-knowledge is really valuable. You probably have many decades ahead over which you can amortize the extreme pain of having to become a wagee again after your hit rate went from 100% to just 50-50. So I can definitely see some of that, but there's also, and I allude to this a little bit in the piece, that sometimes the founders can choose whether or not they raise outside money. Sometimes the market chooses for them, and the way that happens is you have a good idea, you either put your savings into it or just you bootstrap it, and it doesn't need any external money. It's growing, it's cash flow positive, you can grow at some sensible rate, and then someone else comes up with the same idea, they pitch it to a large fund that gives them $200 million to go just make it happen, and suddenly you are competing against someone who can always afford to put more ad dollars into getting the at the top of the funnel, who can put more salespeople on closing deals, who can always promise more to their customers than you can, because if they don't have the feature that their customer actually wants, they can try to just develop it really fast. And so at that point, you sort of have to decide, am I going to be a small participant in this market, or am I going to actually sell to someone who's overfunded and could really use, is basically buying a couple months or a couple quarters or years of progress by acquiring my company? Or do I also raise some money now that it's been validated as not just an idea that can generate positive free cash flow for me, but also an idea that SoftBank or whatever is willing to throw a lot of money at? And that I think part of the SoftBank strategy is actually you take, or at least it was for a while, that you invest so much in the business that nobody else thinks that it's possible for two companies to split this market. And then you actually end up with fewer venture funded competitors. Whereas if SoftBank had been doing rounds 1/10 that size, it would have also validated the market, and no one would feel like, okay, there's no way that there could be three different dog walking startups. Like if the first one raises 20 million instead of 200 million, then yeah, there's totally room for several more, and maybe one of them will end up doing a large round later on. So yeah, you can't always choose it, which is annoying, but it's also like the economy is just not entitled to give you a dream job that is also the best place to put all your capital, but also there's no competition, and also you get to be popular. Like you generally face trade-offs, and if it is a really good idea and you execute it well, at some point that gets the attention of people who will try to make up for your head start and for your talent and just ability to spot good opportunities. They can make up for that with more money.
Yeah, it is really interesting. I mean, one just meta reflection is I used to be, and I'm still interested, but I used to be really obsessed with this idea of sort of cross investing in people. And then I read this science fiction book called The Unincorporated Man, which is a bit dystopian, about a world in which corporations own too much of people, and then people are, effectively, sort of slaves to the corporations. But in my own way, I experienced it, having hundreds of investors and feeling like when you have investors, you kind of feel like you work for them. And now not having investors, there's just that freedom is there are pros and cons, but just the idea of cross investing in people, in some ways it makes you care more about them, but it also can strain things if things don't go as well, or you see people in terms of investments as opposed to kind of independent people. And it's always interesting because via taxes, in some ways, we're all cross-invested in each other, yet we don't see it in that way. It's a little bit hidden. Some people suggest we should make it more explicit. That could be potentially a way for people to appreciate capitalism more. If everyone, for example, was tied into the S&P 500, I think this is Brad Gerstner's idea of a UBI tied to the S&P 500 or something. Do you think this is a good idea? Would you recommend it, or any reflections there?
I think that the unfortunate story of a lot of these is that the time when it is most politically appealing to have the taxpayer make some kind of mandatory or subsidized investment in equities is the time when equities have done really, really well, which is also when they're really expensive. So in the 2000 presidential campaign, I think George W. Bush said something vague about how maybe people should have options other than Social Security, where they could invest that money in a tax preferred account and they could put the money in the stock market. And then this became a bigger deal in like as the year 2000 went on, because the tech stocks peaked in March of 2000 and then dropped a lot. And so you got to say, well, he wants to put all of your, like, privatize Social Security, put all of your money in the stock market, and if he puts all your money in Cisco and Cisco goes down 70%, then you're not retiring anytime soon. And then the time when you'd actually really want that to happen, when you basically want to pass a law saying, okay, every American worker must set aside 10% of their money, put it in an S&P index fund. They can't touch it until they're 65. Like, you want to be doing that in March of 2009, which again, Barack Obama called the bottom of the market within a few days. He said stocks were cheap, stocks ripped. They've never been that low ever since. But it's just not, like, Congress is not going to be excited to vote on something that is forcing or even giving people permission to take more risk after risk taking has done badly. So I think that actually, like, even if it is a fairly good idea, I think actually implementing it is basically impossible. I don't know, there's, maybe you're making it more explicit, but you could also just start telling people that you as an American essentially own a small piece of a giant index fund or a giant endowment fund, really. And that endowment fund it has equity ownership in every American taxpayer. It has equity ownership, de facto equity ownership in every corporation. And so it has a huge, huge budget and is spending that money on your behalf. And it's, the world's largest charitable foundation by a huge, huge margin. But it doesn't really affect people's behavior in any meaningful way. Like, you're just not going to think to yourself, well, if I help this, if I'm talking to someone and they're considering a new job and I tell them, hey, you should negotiate yourself a raise, like, you could probably ask for another 5K and you'd almost certainly get it. And you wouldn't get rejected from the job if you asked for a raise. So it's fine. Just do it. Very low risk, worth it. You're not thinking to yourself, well, I get 1/300 millionth of whatever of that extra 5K they got times whatever tax bracket they're in, like, times the marginal tax rate at whatever tax bracket they're in. Like, it is the value of doing that calculation is less than whatever the actual economic impact is to you. So I suspect that actually, if you try to quantify pro-sociality and try to make it explicit, that it's weaker, and that just trying to live out pro-social norms and then say that that's what you're doing, trying to say, like, I try to give people good advice because I think it is a worthy thing to do. I personally enjoy it, and it's just really gratifying to see people made better off through, see someone's life get meaningfully better because of something that took very little effort from me. Like, that's just intrinsically a nice thing to do. And I think that trying to calculate how nice it is and at what point should I not do that is probably, one, just something you should have low confidence in getting right, and two, it's just not in the spirit of that kind of behavior. So that is sort of my pushback against. I recognize this sounds like much stronger pushback, but America already has a sovereign wealth fund that owns 20% of the S&P 500. It's just the tax code, and you can push back against that. You can say, well, not all these companies pay their full taxes, but the pushback against that is, if we have a tax code that says you pay taxes unless you do X, we are implicitly saying X is actually worth more than the amount of tax revenue we get. So now that's a lot less true if it's something like, if you route all of your revenue through shell companies in low tax jurisdictions and then refuse to repatriate it so that it compounds tax free. Like, okay, that's more dubious. But if it's something like, this company should be paying full federal taxes, but they also bought a bunch of solar panels and they get an extra tax credit against that, so they're not paying much in the way of taxes. Well, in that scenario, the actual tax rate, like the statutory tax rate, is actually a lower bound on the implicit tax revenue, because we are saying that if we will reduce your taxes by $1 if you do X, that only makes sense if doing X is worth at least $1. That is, like, equivalent to a contribution to what those taxes would fund that is equal to or greater than $1. So if you assume that the tax code is pretty efficient and optimal, then the statutory tax rate on a US-based company that doesn't do anything weird with foreign subsidiaries, it is a lower bound on the effective tax benefit that we're getting from those companies, like the benefit of the taxes they're paying. But that's also something that it's more of a cutesy argument. And also, most people don't believe that the tax code is optimal. I don't think it's optimal, but I also would really not want to be the person whose name is on the memo explaining what an optimal tax code would be if such a thing were to be implemented. So it is, but I think part of what that illustrates is just it is really hard to peer through the legal formalisms that we use to actually enact these things and look at what the economic substance is. But the economic substance is that America does actually have, like the American government does own a lot of valuable income producing assets. Those assets don't actually have a market price, but if you wanted, you could try to put one on them. You could try to say, here's the tax base today. Here's how fast we think it compounds. Here's how we think that the government's ability to capture that growth will either get better or worse over time. And therefore, here's the net present value of the future tax income asset that is on the US government's economic balance sheet. It's a big number. I don't know what it is, though.
Yeah, that's well articulated. I want to segue over to something you wrote in Capital Gains this week, which is you explored whether or not we should learn how to code.
Yeah, so it was. I tried to write this for two audiences. One is if you don't want to be a software engineer, should you still learn to code? And the other is, well, if you do want to be a software engineer, but you've also experienced the magic of LLMs, do you still want to learn to code, or should you just get really good at describing what program you want in natural language and not actually learn to code? And the answer I came up with, as you could probably guess, is yes, you should actually learn to code. Either way, but part of it is that I think that there are just part of what being able to code, and I'm really not a good programmer, but I've tried a lot and have written some programs that did things that were interesting to me. Part of what it does is it just expands the scope of things that seem like they are actually worth working on. And I think this is something, like, I think about this a lot with my kids, and I try to emphasize to them as much as I can that everything they see in the world that is not just an artifact of nature, like all of that was built by people. And you are people too. Like, you can participate in this. If you see a car or a plane or a software program, or you're watching a video, like, it was made by people like you who just chose to get really good at making that kind of thing. And maybe they didn't do it entirely on their own. Maybe there's a large institution. That's like, I try to avoid going too far into that level of detail, because I know that I will start talking about the iPhone supply chain or something and just never stop. But like, it's important to recognize that these things, that you can do these things. Paul Graham actually has this really funny line in one of his essays where he says that he did sales. It was really hard for him at his startup, but he did some sales. And he says, if you're just an average person who's not extremely introverted, you might say, like, why is he talking about this as this really impossible task? And he says, well, just consider he says just that he thought about sales the way that the average salesperson would think about modifying the software running on their laptop, where it's just like this totally different domain. They have no expertise. They don't even know where to start. And I thought that was a good analogy, in part because when I read that, I also would not have been able to modify the software running on my laptop. But really, if you write code, that is what you're doing. You're modifying the software that runs on your computer. So we are, like, I am capable of doing that. And just knowing that there are, like, kinds of data analysis where I can't just say there's a lot of data and therefore I'm not going to do this analysis, or like there's too much to put into Excel, so I'm just not going to write that piece. Now I can at least say, like, it's theoretically possible. I could do it. Maybe it would take me longer than it would take if it were Excel-sized data and just easier to slice and dice, but like, it is actually doable. And that just opens up a lot of possibilities. And what it also does is it means that you are harder to bamboozle both by other people and by LLMs if you can actually read the outputs of an LLM and see what they mean and what they do. And I think that is especially important as the world gets more technologically mediated. Just knowing whether or not a claim about how difficult something is to build, or about whether or not it's possible to build in either direction, like, it's good to have some kind of sense for that. And then the last piece is, people have worried for a really, really long time that improvements in the efficiency of writing software would eliminate programmer jobs. Like, this was a genuine concern when people switched from writing assembly to writing in higher level languages. And it just turned out not to be true. Like, there is a performance hit from having more layers of abstraction between you and what the hardware is doing, but there's a massive productivity increase, and software tends to be very complementary to other software in an economic sense. So the more computers there are running more programs, the more the more that life is mediated through those programs, the more cases there are where if you want to build something, there's already nicely formatted data in some digital format. There's already some channel for selling the software product you create to other people. So that it tends to feed on itself for a really, really long time. And it's always possible to imagine that at some point we just reach the limit. We've written all the code we need to write. We have all the programs we'll ever need. But when I interact with software, it doesn't feel like I'm mostly using completely finished products that are, as well designed as, say, the can opener, where it does exactly what it's supposed to do. It's been perfected. There's not really, there might be some marginal improvements, but you don't really need them. Like, I don't feel that way when I use software. I feel like there are a lot of improvements, and that if I had more time, there are just a lot of companies where I would want to get a job improving this one specific feature that I use all the time, and it's slightly broken for me. So I suspect that the scope of those opportunities has gone up. Like, the number of broken software products has risen really fast in the last generation, just because the number of software products has. So the opportunities for doing it again and getting it right, or for taking something that works reasonably well and making it work amazingly, those keep expanding too.
Yeah. I was in a dinner conversation last night. We were brainstorming which sort of professions would be, most at risk. It's always a fun game. There were engineers and there were therapists in the at the dinner table, and we were debating which would be the first to be replaced in mass. And some people were on the engineer side, some people were on the therapist side. Do you have how would you think about this?
My hot take there is that I'm not 100% on this, but I think there's a reasonable possibility that the number of working therapists and the average therapist income will actually go up as a consequence of AI. And the specific reason for that is there are a lot of people who will not consider therapy, in part because they just really don't want to talk to another human being about their feelings and their problems and things. And they could have all kinds of ways to describe why that is, or it could just not occur to them to want to do that. But to the extent that it is just, there's intrinsic awkwardness in telling someone, about something that happened, something your parents said to you when you were 5, and then you start crying, just reliving that memory because it's the first time you've told another human being about this in decades or whatever. That sounds really daunting, but it's probably a whole lot easier to just tell ChatGPT. And so my my suspicion is that that using an AI therapist could be a gateway drug to actual therapy for people, where they can practice it. And you can practice a lot of social interactions with an LLM if that's your thing. And so they might find that it was actually not as hard to tell the story and talk about their feelings as they thought. And they have some practice at it, but they're also not getting completely life-changing answers. And at some level, they just recognize that they're talking to a GPU, like they're talking to a very large list of numbers, and not actually having a conversation with a human being. And that when ChatGPT says, "I'm proud of you and I believe in you," doesn't mean anything other than those are the natural words that complete the sentence that the LLM has already started writing. And so maybe at that point they actually do start using therapists. I think for a lot of interpersonal things, like, I guess it sort of depends on whether the in-person interaction is friction or actually what people are going for, and the economic substance of the transaction is actually only tangentially related to that. Like, there is, just like, if you are going to a local coffee shop, one element of that interaction is you want caffeine. Like, you have a mild dependence on a mild drug and you need your fix. So you go in and get it. But you also have a mild dependence on just human social interaction. And if you have been cooped up at home all day, working alone for a long time, sometimes you just need to see another human being and talk to them, even if it is about whether or not you want cream and sugar in the coffee. So those kinds of businesses, it's just hard to automate them away. And to the extent that we do automate them away, maybe it does say something dark about the extent to which we crave human interaction versus the extent to which we crave interaction with stuff and with digital representations of the real world. But I could see therapists actually doing fine in this environment. And depending on which AI narrative you buy, and depending on which AI narrative gets popular, there could be a lot of people who have a lot of anxiety and a lot of questions about how meaningful their life is. In fact, you could even, I think, if you take like a GDP weighted case, or like, what is the expectation of total economic resources spent on therapy 10 years from now, it's possible that there's like an AI optimist case where actually a huge chunk of the economy becomes therapy, because everything else has been automated away. Like the cost of every manufactured product has deflated to zero. We have energy abundance, and we are all just wondering, what do we do with our lives now? Like we're all, Kubla Khan, just surrounded by unimaginable wealth, just kind of rotting there. So maybe we actually, we're all earning mid 6 to mid 7 figures, and we're spending hundreds of thousands of dollars on all of our therapists, and then the therapists are the ones who have just unimaginable luxury goods because they are they're the last people whose labor actually has value in a post-scarcity economy. Or maybe GPT-6 replaces them all and it's a better therapist. I don't know. It could. There's a wide range of possibilities here, but I think it's hard to automate away human interaction. I think that an AI girlfriend or boyfriend is actually serving a completely different purpose from a normal relationship, and is just not even a close substitute. I've not actually tested this out. I think like the AIs are not good enough that it's actually cheating, but it's still weird. So I haven't done it, but I do think that they're meeting a different need, and that to the extent that AI turns out really well, it does just create a lot more abundance, create a lot more free time, and that always weirds people out.
Yeah, it's funny. My friend was saying, "Hey, how do I justify being a therapist right now in the world of AI or AGI?" And the conclusion she came to is maybe she can be a therapist for the capabilities people, or for the people who are working on alignment, who they see where the world is going and are freaking out already, and can help them perhaps make some advancements. But they'll certainly be happy to hear that you think the world of therapy is only going to expand.
Well, I have a much wider range of plausible possibilities.
Yeah.
So I do think, like, I don't know entirely what the true underlying function of therapy is, and I suspect that therapists will also debate this among themselves. Like, if if you could trick someone into talking to the therapist for an hour, the therapist has actually left the room and is gaming or something. Like, does that lose all the value? Is all the value from the therapist giving people advice, or is actually a huge fraction of the value from having someone who you can talk to about your problems, and or even just being able to say out loud what's on your mind? I think that you could make arguments for each of those, and that if it is just like therapist as sort of a prop while you perform your one-man show about all of your anxieties or all of your regrets or whatever, like that, in that model, maybe the AI is just better at prompting you to keep doing that. But in the model where you actually want to have a conversation with a human being and have them relate to you and basically tell you, like, here, some of your reactions are pretty much just what one would expect someone to do or feel in that circumstance, and then here are some things where you should actually kind of work on that, and it's probably not good for you to react that way, and have you noticed that most people don't, etc. I think that those things can all be those are all like different models of therapy, but I think in that model it is probably just, it's more meaningful to hear it from a person, even if the person's advice is not as good as the AI's advice. Like it's just easier. Like, for one thing, you can't really let the model down. Like, it doesn't mean anything if ChatGPT is really disappointed in you. I've disappointed ChatGPT by making requests all the time. So, and I never felt bad about it. But I think if I let an actual human being down, if I told them, I'm explaining something and they say, well, you seem to have a habit of doing X, and that habit seems actually pretty self-destructive, and I say, yeah, you're right, I'm going to stop doing X so much. If I talk to them in a week and I'm still doing X just as often, that actually feels bad. It just doesn't feel bad to look back on Chat GPT conversations and find out that I didn't follow its advice.
Yeah. The and for engineering, do you think it's like barbelled, where the top engineers are going to make much more money, but just overall there'll be less engineers, or do you think there's going to be more engineers?
I do think it's barbelled. I think the more engineers question is tough, but my bet is probably yes, there will be more of them. And I think there are two components of that. One is just, if you have more software products in general, you have more possible interactions between the two, and that does seem to lead to a lot of headcount growth. This is the answer, I think, to the puzzle of why do so many people work at DocuSign, is that DocuSign has to work with so many other products, and you need people to write all of these different integrations. Maybe that stuff is fully automatable, but it requires good documentation, and to get good documentation, you probably want to have someone who can read the source code and also can, has some ability with natural language to at least review the outputs of your AI documentation creating tool. And we'll see how soon things improve in that dimension, because there is some really cool stuff out there in that area. But I think there's at least more demand for software in a world where AI works well. But also AI, at least in my experience, it has this interesting effect on productivity, where it makes interruptions a lot easier to handle. Because if you are going back and forth between your text editor and your chat GPT window, and you're saying, how do I extend this function to do this, or I'm getting this bug, can you help me work through it? What you also have is this constant log of what is the last thing you accomplished and what is the current thing you're working on. And so if you are either very distractible because you are, I don't know, working at home with small kids, or you're just a very distractible person and you're checking Reddit a lot, like either way, it's easier to get back in the groove if you are continuously taking notes, and AI actually enforces that. So it makes different work styles more possible, and it also just makes it easier to explore different rabbit holes. It makes it easier to try different ideas. It's just much faster to crank out a minimal version of some product. And some of those products, like most of them, will be terrible, of course, because most new things just are. But some of them will turn out to be pretty good. And if it's just easier, if you can build 100 prototypes in the time it used to take to build 5 prototypes, then you have much higher odds of building something really cool that ends up requiring you to hire dozens of other engineers to keep on improving it later on.
Yeah. The last question related to this: have you seen Chris Pike's sort of blog post about sort of the end of software, comparing it to media? He basically says what the internet did to media is it sort of made it so that anyone could create media, and thus sort of made sort of people making media way less valuable. And something similar is going to happen to software, where there's going to be an explosion of capabilities, and thus it'll make the people who had previously exclusive ability to make software less valuable. Do you have any? Did you see that, or do you have any commentary to it?
I saw the headline. It felt like something where someone's going to make a really bombastic case, and so I did not actually read the article. But the media comparison is interesting, because I don't think that's actually happened to media. Like it is slowly happening in some sense, but what actually seems to have happened to media is that there are more people who can work as entertainers than used to be the case, and there are more ways that they can monetize that, and that you can be a professional entertainer in a narrower domain. Like I'm in some sense part of the media, in some sense I'm an entertainer, and my job would just not have been viable if distribution were harder to accomplish. So I don't buy the analogy, so I guess I don't buy the thesis. And I think that it's your definition of what a software engineer is always going to be anchored to what kinds of software have you written, or what kinds of software do you have experience with the development process of. And so I think, like, going back to the point about higher level languages, like if you thought of software engineering as always being able to optimally use every register, and using every last bit of memory in the perfect way, and squeezing very complicated features into surprisingly few commands, then yeah, it was the end of software engineering when people could write C. But no, it turns out that actually they just wrote a lot more software in C, and performance was almost as good, and for some purposes probably better. It's just I suspect, like, it's easier to do the first 90% of optimization, something higher level, and then for the last bit of optimization, you just need to get pretty low level. Um, and then you could have also made a similar point about the rise of higher level languages. So, Python, you could do a rough draft of something much faster in Python, but that again has not actually limited jobs. It's meant there are just more software products out there, and there are also more people who are learning to code as some small part of their job. Like it's always really impressive to read about someone in either academia or the business world in, say, the 1960s or 1970s, where they had some problem that they were working on, and they taught themselves how to code, and then wrote a simulation or something to solve that problem. Like, that was actually a really hardcore thing to do circa 1970, but no longer. Now it would be kind of like if you were running into some problem, you're researching something, you need to simulate something, and you just throw up your hands and say this is too complicated. Like, that is actually the weirder thing to do now. The simpler thing to do is just buy a basic book on Python and learn how to simulate it, and you'll have skills that could be applied to other things. So I disagree with that thesis.
Yeah. Um, Good. That makes sense. Well, let's wrap on that. We're at time. Bern, as always, great conversation, and until next week.
All right, sounds good.
Thanks for listening to The Riff. Please go follow and subscribe, give us 5 stars, and check out Bern's excellent newsletter, The Diff, if you haven't already.